You don't have to have $1 million law firm to do the things that cause people to have million and multi-million dollar law firms. On the other hand, if you don't do the things that cause million and multi-million dollar law firms, you probably won't ever have. And if you ever get one, you probably won't keep $1 million law firm for long.
You're listening to the Profit First for Lawyers podcast, the official companion show to the book Profit First for Lawyers by RJon Robins. Now, this podcast is for you if you want to bring home more profit while working less hours in the office, spending more time with your loved ones doing the things you actually want to do, and turning your office into a lean, mean, profit-breathing machine. So if you're tired of working for your law firm instead of your law firm working for you, stay tuned for some really practical insights that will get you the results you've always wanted. It's time to put your BS aside for the next few minutes and put yourself, your family, your firm, and your profit first. Welcome back to another episode of the Profit First for Lawyers podcast. I'm your host, Carly, and today we are continuing our three-part series on some important financial reports that lawyers love to complicate unnecessarily. Today is episode 2, labor cost ratio. Now, the cost of labor is something that can really quickly get out of control in your law firm if you're not monitoring it. But on the flip side, if you hold too tightly to keeping labor costs low, then you run the risk of not having enough staff and burning out your current staff, or else losing really good talent. And it can kind of feel like you're walking a tightrope trying to keep things in balance with piranha-infested waters below your feet. And those piranhas are hungry, and they have attitudes. Now, your labor cost ratio is a fantastic report to keep your eye on, because it can help you get off of that tightrope so long as you pay attention to it regularly. When we were in the studio recording the audiobook for Profit First for Lawyers, RJon even went a little bit off script in chapter 12 so that he could specifically call out your labor cost ratio as one of those things that can make or break a multi-million-dollar law firm. And I've got that teed up for you. So enjoy this exclusive audiobook content. Let's roll the clip.
Labor cost ratio. How much does your law firm spend on all labor costs in order to produce the revenue that it generates each year? If you spend $100,000 in labor costs to produce $1 million in gross revenue, you have a 10% labor cost ratio. $100,000 divided by a million is 10%. If you spend the same $100,000 to produce $2 million in gross revenue, then you have a 5% labor cost ratio. The lower your labor cost ratio, the more efficient your staff, the more profitable your law firm is likely to be. Oh, and by the way, lest you think this is only for the $1 million, the $10 million, the $20 million law firms, let me ask you a question. How do you think they became multi-million dollar law firms in the first place? They pay attention to these things early on. You don't have to have $1 million law firm to do the things that cause people to have million and multi-million dollar law firms. On the other hand, if you don't do the things that cause million and multi-million dollar law firms, you probably won't ever have. And if you ever get one, you probably won't keep $1 million law firm for long.
Want a 7-figure law firm? Well, then this episode should get you really excited. Now, RJon credits his understanding of this vital report to Greg Crabtree, who is the author of the book Simple Numbers, Straight Talk, Big Profits, which is a book that RJon recommends highly. Now, I reached out to Greg's team to see if he would be willing to come on the show and teach our audience all about it, along with a few other simple numbers tips that will be really beneficial to you. And he said yes. So here's what happened when I spoke with Greg in our virtual studio. This was an information-packed interview. So much so, in fact, that we had to split it up into 2 parts. So today we're playing part 1. Grab your pen and some paper and get ready to take some notes. Let's roll the interview. Greg Crabtree, I have been hoping to have you on this show for almost a year now. I am so excited that you're joining us today. Thank you so much for agreeing to be on.
Yeah, happy to be here. Thanks for inviting me.
For those who may not know, Greg, if you have read RJon's book, Profit First for Lawyers, you probably have noticed quite a few mentions to Greg Crabtree's book, Simple Numbers, Straight Talk, Big Profits. And Greg, you're pretty well known in the industry for really simplifying all of the numbers that people like to try to complicate, right? How
Yeah,
has that been
that's
for
true.
you?
Well, what's interesting is as much as I try to make it simple, I have groups that occasionally say, that's too complex. And I said, listen, I'm giving you two numbers. What's the complexity in that? And and what I find is the people that actually are not numbers oriented handle it better than the people who are classically financially trained. Accountants have the hardest problem with it. Oh, I mean, they want to go into the details, and it's like, no, it's not about the details. This is big picture finance that has the power of hundreds and hundreds and hundreds of businesses that prove this data point over and over and over again, and you can't violate it. I mean, and so everybody keeps looking for the magic pill, and it's like it's not there. I mean, the vast 90% plus of the businesses operate off of one single metric that keeps them successful financially, and that is $2 of gross margin for every $1 of all labor, regardless of what that labor does. And if you meet that standard, there's only a handful of outliers on the high side of that number and a handful of outliers on the low side of that number that can be successful. And pretty much for the professional services industry, I can tell you it's a two. And so now you can choose to overspend money on management and have no people producing, and you'll fail. You can have a bunch of people producing but no leadership, and they'll fail. And I can hire really expensive people to go produce that theoretically don't need management. I got a little clue for you. Everybody needs to be managed, even me, and you'll fail. And it is finding the right balance to be the equivalent of an NFL team, because remember, all 32 NFL teams pay exactly the same wages. Why is it that four or five of them are constantly in the playoffs and in the Super Bowl versus two-thirds of the teams aren't even sniffing the playoffs on a frequent basis? And it's because productivity of labor. You spent dollars and did not get productivity. And that's what we're all trying to find, is what is that magic balance of labor across the continuum of some people at the beginning of their career, some people at the mid of their career, some people at the end of their career, but it's all got to blend and work together as a team.
Oh, Greg, I feel like that is such a great teaser for
Yeah.
this particular audience. I think, we are made up mostly of law firm owners and not
Mm-hmm.
financial um, experts. And so I think you were speaking directly their language. I'm really excited. Before we get into kind of the nitty gritty of
Sure.
what information we can give to the audience to make sure that they are
Mhm.
getting a lot of actionable value.
Yeah.
Let's talk a little bit about your background and how did you get interested in finances and in this particular career path especially?
Well, as a kid who grew up on a chicken farm in Alabama, when you have 10,000 laying hens and you gather 7 to 8,000 eggs a day by hand,
Oh,
and you hoe cotton in the afternoon, as the filler when the chickens aren't laying eggs, you long for doing something different that generally you would gravitate to an air-conditioned office. And so my mom had high respect for the tax preparer who did her tax return. And I went with her one year when I was in the 10th grade. And, it's like, hey, this is pretty nice. It's a nice office. This is air conditioned. I think I want to be an accountant. And that is the extent of my investigation. Um, After going through school and getting my first job, I'm questioning my sanity of, oh my goodness, is this what we do? Because actually, I mean, this is dark ages though. I mean, 1978 was when I got out of college, and everything I did my first year out of college is no longer done by a human. I mean, this was all things that were later automated. And so fortunately, I hung in there long enough. But I hate accounting because we overplay it. because I think we miss the point of it's a tool that should give businesses insight as to how to be at the top of their game. And we are far more rooted in compliance work and backward looking things, and we spend all of our time to accumulate the information and very little of our time going, what does it say? And we don't really create reports and presentations in a way to let the data tell its story.
It's interesting that you mention how the data tells a story. We actually had an episode earlier this season with someone who also talked about understanding the language of and kind of the story of what I called at the time bookkeeperese, right? So you kind of looking back on those dark ages, what were some of the aha moments or the innovations that really changed the game during your earlier career?
When I had started my own firm in 1986, after a stint as a controller for a bank, um, I developed some technology skills in the early days of the first generation PC, and I got a hold of a spreadsheet, and my life was forever changed because I could spend less time on the data entry and access parts and more time. What does it mean? What does it say? I was fortunate enough to, have some good entrepreneurs as clients that I learned from, and we would sit down and break bread and talk about, you know, the report that they look at that an accountant would look at and say, this is ridiculous. You're mixing cash basis and accrual, and you're mixing balance sheet and P&L stuff all on one sheet. And then I learned the genius of it once you get to know the person. What are they seeing? What is it that makes sense? And so I've learned more about business from my clients than I've learned from school and my profession. And so as you look at those, and I also learned from the failures too. I mean, when I always like to say, when all else fails, you can serve as the bad example. And so watch a few of those ride their pig off a cliff, and you start to realize, let's don't do that if we can avoid that. So as we looked at that, fortunate for me, it changed my focus to think of myself as a practitioner,
Mm.
and I started thinking of myself as an entrepreneur, and went through some peer-to-peer organizations that you get access to people that'll help you think more strategically, and I went through some visioning exercises with some good advisors, and really kind of came down to my personal mission, which is the mission of our business unit, is to elevate the entrepreneur. So that's everything that we do is focused around elevating that entrepreneur to achieve the maximum potential that they've got in their market skill set and industry capability. And so as I started playing with data, though, I because I have access to private company information, I've long held belief, and I believe it even more firmly today than ever, that publicly held data is worthless for the average entrepreneur to pay attention to. Those companies play a different game. They're short-term focused. The data is, even though it's public, they're not giving you all the public data,
Mm.
to understand. One thing that you'll see a public company never report on is total labor dollars spent. So just keep that in mind. And so I said, okay, well, I've got hundreds of businesses, most intimate details. And so my peer group, my forum that I was in, I was asking them, I said, they were frustrated with their accountants. So I used them as a focus group. And I said, okay, what are we not doing as a profession that you need us to do? And the one thing that just opened up my mind to possibilities was they said, oh, by the way, you see hundreds of businesses, most intimate details. You should have some idea of what works and what doesn't.
They had a point. You did have access to what could be really powerful information that would be helpful to entrepreneurs and businesses, and of course, in our own case, law firm owners, as is evidenced by this conversation we're having. So, what did you do with that feedback?
Now, nobody pays us initially to look at that. And so I had to do something that is totally against an hourly practitioner's mindset, whether you're an accountant, lawyer, medical practitioner, you name architect, all of those. I had to actually study a data that I had in my hands that nobody paid me for, but I
Mm.
did it. And it turned into, oh, I found some very unique things. I found a direct correlation to gross margin to labor. I found a direct correlation to how much cash should you have in your business. What is the deepest negative cash flow cycle a business experiences in a 3 to 4 year cycle? I looked at, hey, why don't we look at our businesses as the most valuable, highest returning investment that we'll ever have in our hands and maximize it to its potential? And as you look at those things and find those patterns, you just repeat the patterns. And then as I studied across multiple, because we don't focus on one industry, we're not a, people think that we're experts in certain industries, and to a certain degree we probably are, but we're experts in many industries because after you see 3 or 4 data sets of an industry, you kind of got it. I mean, it's not a mystery then. And so we work across all industries and we apply the same simple numbers concepts to those industries. And about the only thing that changes from industry to industry is the amount of return on invested capital that's possible. Because are you a capital heavy industry, a capital moderate industry, or a capital light industry? And there's a return on investment target for each one of those scenarios. But once you understand that, that's the first first leg of the stool that you put down. And when I lay that foundation of what that return on invested capital target should be, everything else falls into place in terms of the metrics that you have to strive for in the business. And if you can't achieve those metrics, you got to figure out, you got to go back to the drawing board and say what needs to be fixed, and it might be me.
Mm. What needs to be fixed? It might be me. I
Yeah.
really like that. I think that that kind of goes along with some of what we've been talking about so far this season.
Mhm. Yeah.
But I was going to ask, so in your experience, is the law firm ownership industry, right? Law firms, are they
Mhm.
capital heavy or are they capital light or somewhere in the middle?
Capital moderate. So the distinction between the three is this: if you carry accounts receivable and inventory, you're a capital heavy business. If you carry one of the two, AR but not inventory, inventory but not AR, you're capital moderate. And if I get paid prior to service or upon service and I carry no inventory or no AR, I'm a capital light business. The one other oddity might be I could be a capital heavy business if I require a lot of plant and facilities, but actually most of the time they would be mostly a capital moderate business in that case, because you can mostly finance physical assets that are productive. And so because when I finance those productive assets, those are done in a way that the note payment is essentially equal to interest and depreciation, which you really should look at as an operating cost. Well, law firms don't have any significant fixed assets anymore, as most people don't. So law firms would be that moderate. Now, they can be a capital light business if you operate in an area or a state that allows you to bill in advance and work off of a retainer instead of waiting. You wait until you do something and you bill, and I've incurred all that cost of human labor and then wait to get paid. That makes you a capital moderate to even a capital heavy. So like a personal injury law firm would be a capital heavy because it typically takes about 3 years, for your cases to come to fruition to be able to pay off on average, in the personal injury space. And so they've got a much heavier carry, but once the return starts, then I've got a much higher return potential as well.
Yeah, that makes a lot of sense. Now, what does it tell you? Um, Let me try to phrase this because I am by no means a finance professional. I'm just
Mhm.
a finance curious.
Yep, that's good.
But what does it tell you if I know that I'm capital heavy? How does that change my numbers or the numbers that I'm shooting for?
So a capital heavy business, you have to think about, from a standpoint that how do I fund it? And so
Mhm.
I either have to come to the business so typically a capital heavy business is going to burn cash when you grow rather than create cash. Now, there's a point that once the receivables pay off and all those things, yeah, then the cash will show up. But generally, so a capital heavy business, If you don't bring cash to the table to fund it, and most entrepreneurs don't, you'll try to use a little bit of debt, use lines of credit to fund AR, those type of things. Well, that's a danger because, you know, when you go through a drought, as some professional service firms experience, and you tell yourself, oh, it's temporary, and as the cash comes in, you're continuing to pay operations, but that line of credit continues to stay static, but my receivable base is dropping. And then once my receivables are lower than uh, my line of credit, then I'm the walking dead, at that point.
Ooh, yikes. Yeah, that's not a great place to be in. Okay, so if we have law firm owners that are listening right now that are kind of cringing, what can they do to get back on track and and not ride the pig off of the cliff?
What we teach is we want operating business, especially in the law firm. We want you to have zero drawn on a line of credit. You're not fully capitalized until you have zero drawn on a line of credit. Law firms, accounting firms, architectural firms are noted for over borrowing and being undercapitalized. And those firms are also noted for one other major flaw, which I talk about in the first chapter of the first book, which is distortion of owner compensation.
Mm.
So one of the and you're seeing this now in a lot of the professional services arenas where private equity is moving into those areas. We're seeing it. There's been a few private equity transactions in the public accounting space, some in the legal space. The first thing that the private equity guys get you to do is take that draw that you were getting as a partner and forcing you to realize part of that was for the job that you were doing, and part of that is a return on investment,
Mm.
a dividend. And
And was that
and
a project?
e- every partner in the world thinks that they're worth the total draw that they get. And it's like, no, you're not. Nobody's going to pay you that number with no ownership to just go do what you do, and you get that draw. Part of that, you cannot. Every business owner, you get paid a salary for what you do. Now we can call it a draw, we can call it guaranteed payment, we can put any kind of lipstick on the pig that we want, but it's compensation for the thing you do, and it needs to be in your labor productivity metrics when you look at productivity.
Oh, this is something that our listeners have heard about before. I think RJon wrote about this. I want to say it was in chapter 9 of Profit First for Lawyers. But it's really great to hear about you talk about it here. It drives home the point that he was trying to make.
The other part of that is a a distribution of profits, and or some of it may be tax coverage unless you make a separate tax distribution, but most of the time they're just going to make one solid distribution, and you've got to cover your taxes out of that, and you might have some left over. That some left over is the after tax distribution of your return on investment. And because firms do not want to wade into that briar patch and have an honest discussion with people about the value of your services versus the value of your ownership, you get a lot of these problems with professional practice finance.
Mm, that makes sense.
Yep.
That is really, really fascinating, Greg. I want to kind of transition into because you mentioned, and I believe that I heard this correctly, but again, I am by no means a financial guru. So if I say this wrong, please correct me. But I believe that you mentioned early on that there's really that one metric that most of the businesses that you work with really look at that really tells them the health slash profitability of their business. And I can kind of see how this correlates to that. But let's talk about that a little bit and then let's bring it back around to owner salary.
When we go in to fix a law firm that's not profitable, that
Mhm.
has no cash, heavily in debt, okay, step one, we have to get to truth. What is financial truth? So the step one is we've got to take the owner draws and recharacterize how much of that draw is really compensation for the job that you do. Are you doing management? Are you doing direct billable work? What is the market value that if you had to go hire someone with your skill set to do what you're asking them to do, what would be the market pay? And we plug that number into the compensation matrix of what goes on. Then the rest of it we're going to account for as a distribution, and that'll come into later in the analysis. Once we get the clean picture of total labor, I don't care if it's billable, back office who are sweeping the floor or taking out the trash. Labor's labor. Take that number, multiply times 2. And are we generating enough net fees? So fees minus any out-of-pocket expenses that are passed through and billed to the client. So I need a 2-to-1 ratio. If I'm not at 2-to-1, that's your first problem. Our engine's broken. We can't fix cash flow if our engine's broken. We have no engine to get us to the promised land of where we need to be. So you say, well, I don't know. It says, okay, well, let's do this. How about we're very early in the month of April. So right now, I would ask someone, how much are you going to spend in salaries, the true legitimate salaries, as we fix the owner comp number. So what is the monthly salaries that you're going to pay this month? And let's say that's $100,000. Great. Can you bill net of expenses, to the client, the client reimbursable expenses? Can you bill net fees of 200,000? So is it sales or is it productivity? Hopefully it's not both, but many times it is. But that's your target. And then you dive in and say, okay, what are the best practices? And there's tons and tons of practice improvement material available. There's just not really good clarity on what the target should be. And it's like, well, I mean, to me, the target's the easiest thing to come up with. The rest of it, is nuance of, okay, I got to get humans, which are an enormously variable output engine that does not produce the same thing every day. I always say there's a reason why we never mix labor with something that's not labor, because labor is the only cost that comes to work every day with an attitude. And it's got some good days and it's got some bad days. And I've got to find a way to get it to perform consistently that is in its best interest and my best interest. And then we both win. And how you do that is as wide as the day is long. So, but the key is setting that target first to know what is it that I have to go attack. Once I get the profit picture fixed, then I'm going to approach capitalization. Do we have 2 months of operating expenses in cash, which is all of our labor and all of our general operating expenses? I need 2 months of that sitting in cash at all times. Now, this is what freaks out all the professionals, because they're going, why do I need that much money? It's just because there's going to be a time that you need it and you need to bank yourself at least to that level. Now, you might still need some help in dire circumstances, but we've proven this number because that is the deepest negative cash flow cycle most businesses face in a 3 to 4 year cycle. So to us, that is active capital. Anything over the 2 months number, that's excess capital. That doesn't get you a return, but the first 2 months do. And so if you're not there, guess what happens in a professional practice? You have to go on a distribution diet and retain profits until you get there, which means your line of credit is 0 and we have 2 months of cash. And sometimes that takes a couple of months, 6 months, a year. We've had a couple that's taken 18 to 24 months to do, but if they commit to it, they can do it. It's just a matter of understanding that, hey, this is what good stewardship is corporately. And especially if you're a multi-owner practice, because you have to have these operating principles when you have multiple owners, or else everybody's going to just do a cash grab when there's cash in the account, and you just can't deal with it that way. And once you get to the capitalization target, then we're going to say, all right, now that's good. We're fully capitalized. We're profitable. Do we want to grow? And what does it take to grow? And is there some catalytic spend that we need to make to grow? Because because generally I have to spend first and then wait to get a return. And so in the professional practices world, I'm going to probably have to fund a new partner to bring them on. I'm going to have to fund a major marketing initiative to go build a new market segment of practice, those types of things. Guess what? Those are bets. I don't know if they're going to work. And that's risk capital. That's everybody coming together and agreeing, hey, can we afford to risk $100,000 here and not get our money back? and everybody has to agree to that. And it's one of the things that does keep practices that are not visionary led from growing, because you don't have that compartmentalization of get profitable for what you have, be fully capitalized for where you're at, and now who makes the calls on the bets that we're going to make to go forward? Or are we just going to take what the market gives us?
Dare to take some risks, but be intentional about the risks that you take, and make sure to let those be data led and lean on your trusted advisors to help you. And that's what we've got for you today, folks. Hey, thanks for spending some of your time with me. And if you found this episode valuable, here are just a few things you can do to take action right now, today. 1, visit our page at profitfirstforlawyers.com/action to download our free resources curated just for you. If you go there today, you're going to find our labor cost ratio worksheet so you can take action on this episode. Now, 2, make sure you snag your copy of RJon's book, Profit First for Lawyers, wherever you usually buy your books. And 3, leave this podcast a 5-star review to help us be discovered by even more law firm owners just like you. And join us next time for part 2 of Greg Crabtree's interview, where we'll continue right where we left off. And if you thought that Greg had some real zingers today, wait till you hear what comes next. We'll see you there. Thank you for joining us on another episode of Profit First for Lawyers. If you're enjoying what you're hearing, tell a friend. And visit profitfirstforlawyers.com/action to download the resources that are going to help you put these concepts to work for your law firm. Your future self will thank you for it, and we will see you next time.